How to save on taxes in 2025. This is for W-2 employees. This is for business owners. Now, I'm going to go over some tax strategies that I'd be fairly confident in saying you have not heard of, and your CPA that's just good at filing taxes and doing some bookkeeping probably hasn't caught up on. So today, what you can expect to learn is some deductions that you can take whether you are employed, an employee, a business owner, maybe you own a home. I'm going to explain some things that statistically only a small percentage of Americans even know are available for them. And the crappy thing for a lot of W-2 employees is you have your standard deductions and there's only so much you can write off. So I'm also going to be talking about some investment strategies you can use to decrease your taxes, even invest tax-free, and have better growth than a retirement account where your money's locked away until you're 59 and a half and you get feed for taking it out any earlier than that. All in this video, so let's get straight into it. So I'm kind of going to go back and forth here. For those of you that are W-2, those of you that are business owners, I want to explain a few things. As you're looking at this, you might say, oh, well, I've heard of 179 before. I'm going to tell you things that you don't know about 179. Some of these acronyms, maybe you're seeing where I'm going with it, but please bear with me because I'm going to expose a lot and unfold a lot that's going to be highly valuable. If you're brand new to the channel, make sure to subscribe. All I do here is drop wealth building tips, and I'm not some Gen Zer that learned something from ChatGPT and spits it out. This is what I do by profession, and I work with multimillionaires and billionaires to help me build my wealth, not financial advisors that make $80,000 or $90,000 a year. So what I am showing you in here, I personally do. I practice what I preach. I do every day, and I don't sugarcoat anything. So let's just get straight into the truth of it. HSAs, if you're a W-2 employee, this stands for a health savings account. You can contribute $4,350 per year or $8,500-ish if you are filing jointly. What this allows you to do is actually invest tax-free, get a deduction on your earned income, and pay no taxes on any growth you get through the HSA. The problem is most people do not treat health savings accounts as an investment vehicle. They just use it for medical expenses. So if you have a high deductible medical plan or insurance plan, you're able to actually qualify for an HSA. I use a company that allows for self-direct investments through HSAs, and you might want to consider asking your employer if you can change to a self-directed HSA if they provide HSAs. If they don't, try to look into getting one set up, because what this means is if you make $100,000 a year and you contribute $4,300 a year into it, you're getting a little deduction on your earned income, dropping it below $96,000 in what your taxable income is. Then any investment you make through the HSA grows tax-free, okay? So if I'm making 10% return in my HSA every single year, I'm not paying any taxes on that. And the really cool thing is y'all are being put in retirement accounts where you statistically earn 7, 8, 9% less than that, okay? And you have to pay taxes on these retirement accounts. Maybe you get a deduction on the money you're throwing in there, that's great, but you pay an ass ton of taxes on the way out. Or maybe you don't get a deduction here, but you pay an ass ton of taxes on the way out. Or maybe it grows tax deferred, which doesn't fucking matter because you still pay taxes. So HSAs, great thing. Now for all of you that have a retirement account, whether you are currently a business owner and you want to save on taxes and you have an old 401 or an IRA or whatever it is, you want to look at self-directing into assets that you can choose where you go into. Problem here with these traditional assets is an advisor will convince you to pay them to manage your money, and you got to fund your 401k or your IRA until you're 59 and a half. You're going to pay 10% to the SEC that wants to further make money off of you if you go to collect before you're 59 and a half. And then when you go to withdraw, you pay taxes. It doesn't work because you are literally growing for several decades at 7 or 8%. And you're locking your money away. You're losing to inflation, you're losing to tax when you exit, and you're losing to the hidden cost of time because you can't leverage it. So at the very least, consider self-directing into something like real estate or an oil investment where you can get access to some of the tax benefits of that, and you're investing in something that outgrows the market. And a lot of you guys on here are like, real estate doesn't outgrow the market. My IRA's been growing at 10%. Okay, 10% is crap, first of all, when you don't have leverage. The only way that becomes attractive is when you get into assets where you're paying no taxes. Deduction on the HSA, no tax on any of the growth here. When we self-direct into things like real estate, for example, I'm in funds that have track records of doubling or better every few years. So if you and I want to run hand in hand, you go into a traditional retirement account for 40 years, and I'm just taking that same initial capital and self-directing the real estate deals, I'm multiplying my wealth way faster than you keeping your retirement account pegged to the stock market, okay? The next thing, I kind of mentioned it for a sec, is oil. This is for those of you that are W-2 employees that make $200,000 a year or more, or you're 1099 contractors that are paying taxes on $200,000 a year or more, or you have a net worth of over $1 million. And don't worry, if you don't qualify for that, I'm gonna get into a bunch of other stuff that you can do. You have to be accredited when you go into these oil deals. Here's the beauty of oil. You get a deduction in the year you invest against your earned income. So if you're making $200,000 a year, you're in a tax bracket where you're giving up 60, 70 grand a year to the IRS. If I invest $200,000 that I have saved up, and you could invest 150, 25,000. If I invest 200K, I have what's called an IDC deduction, intangible drilling costs. I can get up to 80 to 100% write-off on the investment capital, therefore paying 0% income taxes in the year I invest. And yes, that's entirely possible. A lot of times IDC deductions are around 80%, okay? And when they're around 80%, what that means is if you invest $200,000, you're gonna have a $160,000 write-off, so your tax basis is $40,000 for the year, which is less than a McDonald's employee. Then these oil deals spit out cash flow. That cash flow has what's called a depletion allowance. For every dollar in cash flow, your tax basis is 85 cents. Then it has what's called tangible drilling costs, which is depreciated over 7 years, which is a further deduction that these oil wells pay, okay? Now, for those of you that own a home, you own a business, you have a short-term rental, you do Airbnb, you sublet a room in your house, something along those lines, pay attention to some of these next deductions that I'm going to go over. If you have equipment, pay attention. And if you're loving this video so far, make sure to smash that like button and subscribe so you can stay updated on all the wealth, tax strategies, and leverage strategies that I talk about on my channel. Let's get straight into it. So there's this cool little section of our tax code called 469I, okay? And what this allows you to do is get a $25,000 passive loss limit on a rental property that you might have. So if you are actively participating in the bookings of a rental property or management decisions or things of that nature, you qualify for this. And this is specifically for those of you that make $100,000 a year or less and you have a short-term rental, something on Airbnb that rents out a few days on average or a couple days or a night here and there, something like that. You can get a passive loss limit of $25,000. What this means is that if you make $100,000 a year of earned income, you can qualify for up to a $25,000 write-off. That is the limit. So it's taking income that you earn and essentially income that you're passively generating from your rental property, and it gives you up to a $25,000 deduction, thus lowering your tax basis. What's 100 minus 25, okay? Now there's some nuances of that, but that is the sort of plain Jane ABCs of that. Then you have a short-term rental loophole. This is another deduction where there's no passive loss limitation limit. There's no income cap. Now this is for those of you that have a short-term rental where you are actively managing that property. You are involved at least 500 hours a year or 100 hours per year more than anybody else, and you rent it on average for 7-day stays or less, 7 days at a time or less. You can qualify for this. And this allows you to get expenses through depreciation or interest. Say you've got a mortgage on your home, for example, but you have a guest home or you have a little ADU or a mother-in-law and you're renting that out. So there's costs associated with that. You've got a mortgage to cover, you have cleaning fees and things of that nature, management fees, and depreciation on that real estate asset itself, then you can qualify for a loss. So let's say that you earn $100,000 a year at your job, but through expenses and depreciation, you're able to show $20,000 of losses. Your tax basis is now $80,000 a year. In a second here, I'm gonna talk about some investment vehicles that all of you guys can utilize, whether you're W-2, 1099, a contractor, or a business owner, that you guys can get into to take your active income, convert it into passive, lower your tax bracket, and even keep your money in places where you can save fully insured that far outperform a high yield savings with way less taxes, okay? So for those of you that are business owners, we've talked about section 179 here, okay? In the corner of the frame here is a 1977 F-250, all right? It weighs over 6,000 pounds. The gross vehicle weight rating on it is over 6,000 pounds. Now, what section 179 says, and it's back to 100% bonus depreciation for this year, okay? Because of the BBB, Trump's big, beautiful bill, depreciation is back to 100% bonus depreciation. So if you're in business, you've got an excavator, you've got, you know, a tractor, you've got this truck, you've got a G-Wagon, you've got something that you use primarily for business that has a gross vehicle weight rating of 6,000 pounds or more, you can depreciate 100%. Now, some idiot's gonna come on here and say, well, yeah, but when you go to sell, you gotta recapture that depreciation. No, you don't, okay? No, you do not. What that means is, I get comments all the time, well, when you go to sell, if you take all the depreciation, they're just gonna recapture it. No, idiot, they're not, because you don't sell it, okay, for one. And for two, that only happens if you do sell within the next 5 years, okay? Then there's no depreciation to recapture. All right, so this truck, for example, here's how 179 works. I buy a truck. I need the truck for business. I don't care whether I finance or pay cash for it. I got an F-350. It's a $100,000 truck. I make $250,000 that I pay myself as a salary every single year, okay? I take the bonus depreciation because I use the truck in business. Now, you can also deduct mileage, but for me, I'm getting more of a deduction with my bonus depreciation. So I pay myself a $250,000 salary. I've got $100,000 of depreciation on my truck, which I am not selling, and it takes my tax basis down to $150,000. Now, some of you guys would be like, great, well, you spent the $100 grand on the truck, so you didn't really save. I'm gonna own that truck for a very long time. It carries its weight in gold with what I have to use it for in business. So I'm saying this is application specific. For some of you guys, it might be a $20,000 truck. For some of you guys, it might be a van. For some of you guys, it might be an SUV, okay? So it's all relative. It doesn't mean you go spend 6 figures on something, but if I have the choice of paying money to the IRS or having a tool that will get me from point A to point B that I can also write off my income with, that's gonna pay for itself over time, I'm gonna do that. So you can use bonus depreciation if the vehicle is new to you. It doesn't have to be new, just new to you. So when I got this truck back in 2010, right? If I had known about 179, I don't even know if it existed then. If I had a business when I was 17 years old, I could have depreciated that the first year that I've owned it. The cool thing is this truck, I get offers of $50K all the time for it now. It's only gone up in value, and that's also what's really cool is you start getting into the nuances of vehicles and things of that nature. They might go up in value, but you can take the depreciation. So that is 179. The Augusta Rule, I love this one. The Augusta Rule comes from the Masters Golf Tournament in Georgia, and here's basically what it says. If you own a home, you can rent the home to an entity. It just cannot be you. And you can use that 14 times a year to deduct against your earned income. Here's the math behind that. If you make $100,000 a year in earned income and your home is rented out to someone else or to a business 14 days of the year, okay? Let's say for $1,000 a night. That is a $14,000 deduction against your earned income. You make $100K, you got a $14K deduction, you have $86,000 that your tax basis is now. So you dropped it $14,000. What a lot of people will do, you could have a home and you rent it out for, you know, to people once a month, you know, and a couple of months, maybe twice or something like that. You have to come up with a fair value. So you hop on VRBO, you hop on Airbnb, you look at comps, you go, oh, okay, a home like mine, $600 a night, $1,200 a night, $500 a night. Now, what a lot of people do and what I do, I got a home down in southern Utah, okay? I own a business. So Ben owns a home, and he takes that house, okay, and he rents it to his business for 14 nights or 14 days a year. So I can take my earned income, I can take this deduction, I can take my bonus depreciation, and I'm paying even less in taxes to the IRS. Okay, now for everybody watching this, and let me know so far, what have you learned that is new? Have you implemented any of these strategies, or is there a particular one that applies to you? Let me know in the comments, okay? Now I'm gonna talk about all of these investing vehicles, okay? Your savings account, typical savings averaged 0.52% depending on the stats that you look at for just a regular savings account. High yield savings vary from 4 to 5%, but the return is guaranteed to you, therefore you have to pay taxes on the growth. I keep my money in a high early cash value, dividend paying, mutually participating whole life policy, okay? Now, a lot of people get misconceptions about insurance. I've made other videos on that. I put a link in the comments below for you to watch those videos. I'm not an advisor. I don't get paid to say this. Now, because I'm exposed to the industry, I also know that 95% of the cash value insurance policies issued in the United States are inferior to what I have less growth, hidden insurance costs, and they're what advisors are incentivized to sell. I happen to have the same type of policies that the banks buy, okay? Banks have what's called BOLI, bank-owned life insurance. They bought over $11 billion worth of it in 2024. They continue to in 2025. And so in this policy, I have a 2 to 4% guaranteed return, which varies on the individual. Mine's 4%, and I have a dividend, which is 6.4%. This dividend comes to me tax-free. Right? And I just have it set up where any growth goes back into the cash value of the policy. I don't touch it. This is fully insured, better than FDIC. So it continues growing, and that's where I keep my money because the growth of cash value far supersedes the insurance cost. I can get a line of credit against it, and this dividend is tax-free. My dividend alone is higher than the rate of return in your high yield savings account. You have to pay taxes on that. I don't. So I keep it there. 99% of the advisors you're going to talk to don't know shit about this, okay? If you want to learn more about that as well, I have a community called the Capitalist Network. I included a link in the description. We help people get access to these. We help them get lines of credit against it, and we help you invest into these very things. And we even provide you the CPAs so you can start implementing this stuff, because your everyday CPA knows less than a quadriplegic turtle about this stuff than what they actually should. The next and last thing I want to go over here is your oil and real estate. Passive income, guys. You convert your earned into passive. So all that income that you're earning, if you're a W-2 employee, you only have so many deductions you can take. So any chance you can stop saving and start investing in things that multiply your money and decrease your taxes, you want to take advantage of that. So I've got real estate funds that, you know, for as low as like 25 grand, you can invest in these, and they have a high rate of return, they have high appreciation, they have tax incentives, and every time I exit one of those funds, I just roll it again and roll it again and roll it again. And I'm with companies that historically have track records of doing 2x returns, 2.5x, somewhere in there, in only a few year period of time with tax incentives. So I just snowball that. I go into oil for those of you that are accredited, but you can get into the real estate game non-accredited. I go into high rent growth markets where year over year rent growth is 8 to 10%, markets like Kansas City. I've also made videos on my channel about this as well. And I'm partnered with a fund that I actually trust, and they're able to deploy my capital for me, help me create cash flow with it, help me create appreciation, and I do it time and time and time again. And again, people think that real estate's risky. It's risky if you're an idiot. Any investment is risky if you don't understand the asset. Appreciate you guys watching this video. Let me know in the comments the most valuable tax information you've picked up today, and I'll see you in the next video.